This is Sovrun, where we simplify complex markets. Today, we're explaining the engine of the futures market, margin and leverage. I'm Rob, founder of Sovrun and a systematic investor. Every strategy, every metric, every video on this channel is built on real data and a disciplined framework. At Sovrun, we don't trade on gut feelings. We automate risk management, execution, and exits, so the numbers make the decisions, not emotions. Ever wonder how some traders control huge positions with tiny accounts? In early 2024, as the S&P 500 crossed 5,000, the CME adjusted margins multiple times to handle the heat. It's the ultimate double-edged sword. You can control a massive fortune with a small deposit, but a tiny move can wipe you out completely. Are you trading the margin, or are you trading the risk? Think of futures margin like a security deposit on a luxury rental car. You don't pay $100,000 to drive that Porsche. You just give the agency a $2,000 margin. You have full control of the car, but if you scratch the paint, they take it from your deposit. In futures, your margin is the good faith bond that lets you control the whole contract value. To find your leverage, first calculate the notional value. Take the S&P 500 at 5,400, multiply by the $50 multiplier, and you get $270,000. Now, divide that by the $12,000 margin. That's 22 times leverage. A 1% move in the index becomes a 22% gain or loss on your cash. Talk about a force multiplier, for better or worse. Not all leverage is equal. While the S&P 500 sits at 22 times, a 10-year Treasury note can reach 65 times leverage. Why? Because bonds usually move slower than stocks. Gold is around 15 times, and crude oil sits at 12. Compare that to buying a standard stock, where you're capped at just 2 times. Futures are in a league of their own when it comes to efficiency. Remember August 2024? The yen carry trade started to unwind, and the Nikkei futures dropped 12% in a single day. Traders leveraged at 10 times were wiped out in hours. Their entire security deposit vanished before they could even react. It wasn't just a market dip, it was a math problem. When the price move exceeds your margin, the clearinghouse closes your position and your money is gone. Leverage is capital efficiency, but it's dangerous if you forget the big number. Don't focus on your $12,000 deposit. Focus on the $270,000 obligation you're actually trading. The biggest misconception is thinking margin is a loan with interest. It's not. It's a performance bond. Respect the notional value, or the market will take everything. Always manage the risk, not the profit potential. Engineers use levers to lift heavy weights, and you use financial leverage to move capital. If you want to think about markets the way a systematic investor does, follow the Systematic Investor on YouTube, TikTok, and Instagram. Learn more at sovrun.io. This is Sovrun, and this is how we invest.